The previous years have taught us that the market is extremely volatile, and if you have zero knowledge about it, you're bound to suffer. However, despite the struggles we experienced in 2022, we should remember that it's inevitable and the market will always have its downturns. On the good side, the whole direction of the market is headed upwards. Hello and welcome to Eminent Investments. Today we'll talk about how you should invest in 2023, and if you're a beginner, then lucky you because we're discussing the basics. Before we start, give us a like and subscribe to the channel. If you're done with that, then let's get right into it. If you take a look at the best performing investments in recent years, you'll find that the stock market and real estate have been at the top of their game. However, you might find yourself asking how? Just how does a beginner navigate their way through those things? Why should you invest in stocks? Let's start with the basics. What are stocks? Stocks are simply businesses. When these businesses want to raise funds, they sell portions of the company to the stock market. Those portions are called shares, and if you purchase one or more of those, it means that you also own a part of the business. As a business owner, you also generate your returns whilst owning a specific share. That's the benefit of investing in stocks. You're purchasing and owning various businesses whose main goal is to make money for you. On top of that, it's passive income, which means that you don't need to heavily work to earn. You can let it cultivate your returns while you watch your favorite shows or pursue your own little hobbies. Now let's talk about the basic steps in investing. Before we get into it, we would like to remind you that being a millionaire is not a prerequisite for investing. Anyone can do it, and the stock market makes it easy for anyone to make their purchases. Get a stockbroker. The first step in buying a stock is by signing up with a brokerage company, which is a platform that enables you to purchase stocks. Make sure to collaborate with trustworthy companies that are also friendly to your pockets. Some affordable options are Robinhood and Webull. However, if you're looking into proven and tested ones that are a bit more pricey, there's Charles Schwab, Fidelity, and TD Ameritrade. Familiarize yourself with basic terms. After securing a stockbroker, you should first familiarize yourself with a few key terms before investing in a stock. There are 3 crucial terms to know. Ticker symbol. This serves as a stock's nickname, and it's also a simple way to find the specific stock. For example, Amazon utilizes AMZN as its ticker symbol, while Microsoft has MSFT, and Disney uses DIS. Market order. When thinking twice about the stock you intend to buy, there are 2 basic kinds of buy orders to be examined. One of those is a market order, which involves placing an order to sell or buy a stock at the best available price in the market. Although it secures the acquisition of the stock, it doesn't give a specific price. A limit order. These are set restrictions on the highest permissible price that you can pay or earn in buying or selling a stock. If the order has been made, it'll be specifically on or below the limit price. Create an investment strategy. When you find a stockbroker, you can now buy, sell stocks, and build a portfolio. However, a strategy is crucial at this point. Just as games like chess and football demand strategies, investing in stocks also stresses great focus on strategies. With this, it's essential to decide how you plan to approach the investment game. Furthermore, there are 5 main categories of investing strategies that you can follow. Value investing. Charlie Munger and Warren Buffett adhere to this strategy, and that must tell you something. Quite simply, value investing is hunting stocks that have greater value than their market price. There are 4 steps to remember while you apply his strategy. You must understand how the business works, which means that you should know its internal components, how it generates money, or even what its products are. Find businesses that have a competitive advantage. These are the kinds that are unique and are able to beat their competitor due to how incomparable they are. Have management with talent and integrity. Managers are an integral part of the company's growth, and if you have a bad one, this will affect everything. Buy at a rational price. It's important to think of the stock's long-term value compared to its current price. You don't necessarily have to pay heaps for a stock. Just remember to pay at a fair price, or even better, a cheap one. Dividend investing. If you're fond of consistent cash flows, then this strategy might be for you. When a company generates income, it can either reinvest that back into the business or they can use that to pay stakeholders. The latter is termed as dividends, and they do payouts quarterly and monthly. However, it has issues with inconsistency, so look into investing in dividend aristocrats, which are stocks that have increased dividends in the past 25 years. There are also dividend kings, which are stocks that have done the same as aristocrats but for 50 years or more. Such stocks have never cut dividends even through recessions. Passive investing. If you want a more laid-back approach to investing, then this strategy might be the best. Contrary to popular belief that this won't generate much income, index funds, which is a passive investment, beat 83 to 95% of active money managers. This proves that passive investments, which are simply buying a whole bunch of ETFs and index funds, do better than hand-picked stocks. Other than that, it diversifies your portfolio and saves you from risks. According to Buffett, the best and safest investment is through the S&P 500, which he betted on with a small amount back when he was a kid and has now generated $400,000. Growth investing. This is for the investors who like taking risks. Growth investing holds a lot of risk, but if the market favors you, then you also get rewarding returns. This encompasses stocks such as technology, innovative and disruptive. Reports show that they have been doing well recently, and such examples are companies like Tesla, Amazon, Netflix, Apple, and more. To succeed with this strategy, you must find the good stocks amid the bad ones. You should also start investing when the bull market begins as opposed to doing it when the cycle ends. However, do know that this investment strategy will struggle if the economy plummets to the edge. Volatility investing. Michael Burry, the inspiration behind the Big Short movie, is in favor of this strategy. Back in 2008, he shorted the market and made tons of fortune as the market crashed. With volatility investing, you can either short the market like Burry, or you can do it like George Soros, wherein you ride stocks as they rise. Know the numbers and key ratios. Newbies and inexperienced investors will struggle in their journey if they get too confused with keys and terms. With this, we have a little checklist. These are the 12 stock ratios that every investor must learn. If you want an easier time investing, then you should familiarize yourself with each one and what their functions are. Familiarize yourself with different industries and sectors. The economy is built with different sectors and industries, and it's essential to choose sectors with promising potential that align with your investment horizon. Overall, there are 11 key sectors in the economy. First is the technology sector, which includes companies like Apple, Microsoft, Nvidia, and IBM. Second is the financial sector, and examples of these are banks like JP Morgan and Wells Fargo, as well as insurance stocks like Chubb and AIG. Third is the communication services, composed by companies such as Google, now Meta, and T-Mobile. The fourth sector is consumer cyclical, and these businesses are much like Amazon, Tesla, and McDonald's. Fifth is consumer defensive, which is basically essential goods manufacturers like Walmart, Costco, and Target. Sixth, the healthcare sector, pretty much self-explanatory. Seventh is industrials, which consists of companies that specialize in manufacturing and shipping. The eighth sector is real estate, which covers both commercial and residential buildings. Ninth is the energy sector, which deals with oil and gas companies, while the 10th sector is basic materials. Lastly, the utility sector, which involves companies that provide utilities such as electricity and water. Which of the 11 sectors do you understand the most? Which ones do you think will thrive in the future? Try weighing your options and choose which ones to invest in. Know how to study a business. Before you go and buy stocks, it's essential to comprehend and analyze a business. A stock carries the business entity, so it's important to thoroughly familiarize yourself with it before spending heaps of money. Let's use the Apple stock as an example. Apple offers a lot of products and services, and with this, you should predict the performance of the company's revenue streams. Rather than focusing on other matters like politics, shift your attention to understanding the business dynamics and future performance. Create a strategy. The market is unpredictable, so you should take control of it rather than having it the other way around. Don't allow your emotions to overtake you, as it's important to remain calm and rational. To avoid making rash actions, make an investing game plan. Think about what you will do if a recession comes. Just always remember to be rational, because tendencies are, and most investors will get too emotional. Start small. Some investors simply give up due to being overwhelmed. To avoid that, slowly dip your feet into the water and progressively learn how the game is played. Although investing can be a fun game, you need to be wise. We hope we've given you an idea of how you should get started in your investment journey. If you liked our content, do give us a like and subscribe to the channel. Once again, this is Eminent Investments. Thank you for watching, and we'll see you next time.